Hello, this is Brian Shannon from Alpha Trends Blogspot. It's Friday, the 7th of December, 2007. The market's closed, and the S&P 500 lost 28 cents, about 0.2%. But it did hold above that 50-day moving average, so hopefully we're going to see that level, the 150 level, and right near that 50-day moving average and the neckline do act as support. Next week is going to be very important. Of course, we've got the Fed on Tuesday. That ought to shake things up a little bit, but right now it's looking like this market is attempting a recovery that may hold. You can also look at this downtrend line and say, well, maybe it's not going to hold, as that it could potentially offer some resistance. We also see that the larger picture shows the potential for some selling near here because of a 61.8% retracement. So the theme continues that there's a lot of mixed messages being sent from this market on various time frames. So again, next week we've got the Fed on Tuesday. That's going to shake things up. Things could go either way in here. Don't get locked too hard into a belief that the market is going to do one thing or the other, because as we've seen, a flexible opinion in here has been very valuable over the last several months as this market just gyrates back and forth. The 200-day moving average, it's nice to see that the market was able to hold above that this week. Bullishly, we also saw that the market did make a higher high and a higher low. So we have a pattern of higher highs and higher lows over the intermediate term. Unfortunately, again, it brings us right to this level of the downtrend line, and also, again, from this high to the low right here, the market is now retraced 61.8%. and it's near that 50-day moving average. So I think the most sensible thing for this market is maybe a little bit more consolidation through time. A little bit further consolidation in here seems to make sense. On the 10-minute time frame, we do still have a bullish picture here. We have a rising 5-day moving average, so we do want to continue to give the benefit of the doubt to the buyers. This trend line may be important next week. Keep an eye on that. And also, of course, this level of resistance that we broke past near about 149.25 or so, breaking back below that level could put this recovery in jeopardy. So it's something to be aware of. But again, the other bullish thing we have to look at is this inverted head and shoulders pattern. And the last time we had a pattern that looked like this was again back in August, as the market bottomed off that. And if you look on my blog and type in under the search component inverted head and shoulders, you'll see that I had pointed to a couple examples from 2005 and 2006. There were similar setups in the S&P 500. So history has been that these are good patterns for the S&P 500. Whether this one will live up to its bullish projections that would give us a rally up towards about 157, we'll see. The jury's out because, again, a lot of mixed signals on these different time frames. So it remains a trader's environment. Things are definitely, I think the bulls can breathe a lot easier than they have over the last couple of weeks. It seemed as though maybe this level would be resistance, and if the market had failed there, as I'd outlined in the video marked longer-term view of the S&P 500, then it could have really put this market in bigger danger, as I said, of a multi-year bear market. So far, it looks like that's been saved, and that is, the market's been saved from that bearish scenario. Today's action, just kind of choppy back and forth above and below the daily VWAP. So just consolidating really some of the gains of the last few days, I think, is the best way to look at it. The semiconductors, again, this past week, they showed a higher high and a higher after making this higher low earlier in the week. So they made it past that resistance level. First, we were looking at resistance at 418. It made it above there, and then yesterday it cleared the 425 level. So these levels are going to be important as far as support. Actually, 423 and then about 418 will be important levels of support for this market. If it can continue to hold up, then I think the target that I was kind of outlining yesterday, and this is a counter trend trade, so it's not a high probability trade by any means. So just keep that in mind if you are trading the semiconductors, that a 38.2% retracement of the recent leg lower from here would bring it up to 440. That's where it also might find some resistances. It had some right here earlier, and that's about where it may meet the declining 50-day moving average, which often does act as a resistance. So continue to be cautious if you're trading these semiconductors to the long side, because the primary trend is still clearly lower. There's really no sign of relief on this weekly time frame, and you've got to expect that any rally that ensues from here is likely going to be just a bounce within this primary downtrend. The Russell 2000, we'll keep it on that weekly chart, still looks to be the worst. This important support level for the next, who knows how long, 6-9 months, is going to be this 73 level. Breaking below that really could do much further damage to this market. The market is rallying up to these declining moving averages. We've got a declining 10, 20, 30, and 40-week moving average. Typically, that's not a good sign for the bullish scenario, but when you look at the daily time frame, you can see that, again, mixed signals across different time frames. We do have a declining 50-day moving average below a declining 200-day moving average, and I've never seen that to be a positive event for the market. It is also coming up to this level of prior significant importance as far as support and resistance, so that's getting closer by the day. Today the market was up a nickel, or 0.06%, and it's approaching that declining 50-day moving average. We've seen some resistance for this market at the 10 and the 20-day moving average, so a lot of times the bounces to the 50-day moving average provide the next level of resistance. And you know, we can look at all kinds of different conflicting signals in here, like this inverted head and shoulders pattern, which again gives us a price objective up near $82 a share. But before you can ever think that this market has the ability to get up there, we've got a lot of obstacles in the way. $80 is potentially a major level of resistance, potential resistance, because it may just blast right up through there. You never know what resistance is until after the fact. So, you know, even when the market came down to the 73 level, people were saying, well, there's support there. There's support there, they said, because it found support there once. It doesn't mean it will the second time. So continue to just kind of be very cautious on this group, the IWM overall, because this is the area where we've seen the most selling, the most trouble for the bulls. And again, as far as the most recent rally or decline rather, the most recent major move lower from this high to that low, the market has first found resistance at the 50% retracement. Now potentially at the 50%. I'm sorry, that's 38.2. I think I said 50. 38.2% retracement level. Now it's rallying up towards that 50% level. We've also got a declining 50-day moving average in that area. So there's reasons that we may find resistance in there. Support and resistance levels from moving averages and Fibonacci and that sort of thing tend to be more of a self-fulfilling prophecy than any kind of magic support or resistance area. It's because enough people look at it and say, well, it's approaching the declining 50-day moving average. I'm going to stop buying. That removes supply from the market. As the market rallies up towards that 50-day moving average, the people that were long from in here start to say, well, it's looking like it's rallying up to that 50-day. The 50-day tends to act as resistance. I'll offer a little bit of my long stock out. That adds more supply. Others, people who are sidelined on the cash looking for an opportunity to sell short, will see that 50-day moving average and say, that's a good place for me to sell short for the next leg lower. Realistically, let's just see how it acts when it gets there, but that's the psychology of why it tends to act as support or resistance at a moving average or Fibonacci or something else that's really not meaningful except for the fact that enough people follow it to make it meaningful. And that's the value of a lot of technical analysis. So we've got that potential area coming up. Keep an eye on it. View it not as a signal to get short or a signal to exit any longs that you may have. View it as a reason to start looking more closely at the shorter term time frame and to identify if there is in fact a turning point coming there, and you'll see it based on these shorter term time frames long before you'll see a doji form or whatever candlestick or anything like that. The NASDAQ 100 made some impressive ground this week. It made it past this prior level of resistance, which then became support, and the same things I said 3 days in a row. But it came up there. It's a little bit extended now, and bullishly it closed above that 50-day moving average and this line that I had drawn straight across. You got to look at a stock like Apple. which is a huge portion of the NASDAQ 100, closed at an all-time high today. And some of these other stocks are looking like maybe they're headed that way too. Baidu, Google, some of these stocks are really acting strong. Can the market overall continue to rally based on the strength of a more confined leadership role? Overall, if you look at it, the NASDAQ 100 doesn't look as bullish as or it looks more bullish rather than the NASDAQ composite, which hasn't quite made it past its important level of resistance. So still kind of the jury is out. It looks a lot more bullish than it has, but again, the jury is out. This volume is declining. Volume doesn't pay, but it's a reason to just kind of cast an eye of suspicion on this rally. If it's to fail here, who knows? But for now, there's nothing suggesting in the short to intermediate term that this rally is failing. I think that 51 and a quarter or so is an important level, as is 52 as potential support. If those levels fail, then we've got bigger problems. But there's nothing suggesting that right now. Again, overall, the overall picture remains very mixed. A lot of different conflicting signals coming from not only different time frames, but from different market groups as well. So you don't let your confidence get ahead of what prices are telling us. And the biggest enemy in the market is complacency. Always have your guard up and be prepared for what may go wrong.